Hey everyone, my name is Beth. Welcome back to where we break down everything you need to know about cryptocurrency and investing. Today we're talking about a strategy that can help you navigate the ups and downs of the volatile crypto market called dollar cost averaging, or DCA. This is a powerful tool in your investment toolkit, especially if you're looking to build a position in crypto without stressing over market timing. So let's dive in. First off, what is dollar cost averaging? In simple terms, DCA is an investment strategy where you divide the total amount you want to invest into smaller, equal portions and invest those portions at regular intervals, regardless of the asset's price. For example, instead of investing $1,200 in Bitcoin all at once, you might invest $100 every month for a year. This way, you buy Bitcoin at various price points, which helps to average out the cost of your investment over time. The key benefit of this strategy is that it reduces the impact of volatility on your overall investment. Since crypto markets are known for their wild price swings, DCA can help smooth out the ride. Rather than trying to time the market, which is notoriously difficult even for seasoned investors, you spread your risk over time. Let's talk about why this is beneficial. The crypto market is highly volatile. Prices can swing wildly in a single day, let alone over weeks or months. For example, Bitcoin's price could be $30,001 a day and $25,000 the next. If you were to invest a lump sum during a high point and the price drops right after, you could face significant losses. This is where DCA comes into play. By spreading your investments over time, you buy in during both the highs and the lows, which helps to average out the price you pay. Imagine this: you decide to invest $1,000 in Bitcoin, but instead of doing it all at once, you break it down into $100 investments each month. In the first month, Bitcoin is priced at $30,000, so you buy 0.0033 BTC. The next month, it drops to $25,000 and you buy 0.004 BTC. The following month, it rises to $35,000 and you buy 0.002929 BTC. Over time, you're buying more when prices are low and less when they are high, which averages out your cost and reduces the risk of buying at the peak. This strategy is particularly useful in a market as unpredictable as crypto. It takes the emotion out of investing and provides a systematic approach to building your portfolio. One of the biggest challenges in investing, especially in crypto, is managing emotions. Fear and greed can drive poor decision-making. When prices are soaring, it's easy to get caught up in the hype and invest more than you should. On the flip side, when prices are plummeting, panic can set in, leading you to sell at a loss. DCA helps mitigate these emotional reactions by establishing a set routine that you follow regardless of market conditions. By committing to invest a fixed amount at regular intervals, you're less likely to make impulsive decisions based on short-term market movements. This discipline can lead to better long-term outcomes, as you're consistently investing rather than trying to time the market, a strategy that even professional traders often struggle with. Dollar cost averaging isn't just about mitigating risk, it's also about building a portfolio over time. If you're new to crypto, or if you're gradually increasing your exposure to digital assets, DCA allows you to build your position steadily. Whether you're investing in Bitcoin, Ethereum, or a basket of different cryptocurrencies, DCA lets you accumulate these assets without needing a large sum of money up front. This gradual accumulation is particularly beneficial in a market as dynamic as crypto. You might not have the resources to make a significant investment all at once, but with DCA, you can slowly build your portfolio, taking advantage of various market conditions. Over time, as the market grows and matures, your investments have the potential to grow as well, especially if you're investing in fundamentally strong projects. Another major benefit of dollar cost averaging is its focus on the long term. Crypto markets can be incredibly volatile in the short term, with prices swinging wildly from day to day. However, over the long term, the market has shown strong growth, particularly for established cryptocurrencies like Bitcoin and Ethereum. By using DCA, you're committing to a long-term investment strategy. You're not just looking for quick profits, but are instead building a position that could grow significantly over time. This approach aligns with the idea that timing the market is more important than timing the market. Instead of trying to predict short-term price movements, you're investing steadily over the long haul, which historically has been a more successful approach. DCA also provides flexibility. You can adjust the frequency and amount of your investments based on your financial situation. For example, if you receive a bonus at work, you might decide to increase your monthly investment temporarily. Conversely, if money is tight one month, you can reduce your investment. The key is consistency over time, rather than the exact amount you're investing at any given moment. This flexibility makes DCA an accessible strategy for almost anyone. Whether you're a seasoned investor with a large portfolio or a beginner just starting out, DCA can be tailored to fit your financial goals and resources. Let's look at an example to see DCA in action. Imagine you started investing $100 per month in Bitcoin back in January 2018 during the last major bull run. Over the next few months, Bitcoin's price fluctuated dramatically, dropping from around $17,000 to as low as $6,000 by mid-year. If you had invested a lump sum at the peak, you'd have seen significant losses. But with DCA, you would have purchased Bitcoin at various price points, averaging out your cost and reducing your exposure to the high volatility. Fast forward to 2021, when Bitcoin reached new all-time highs. Your DCA strategy would have allowed you to accumulate Bitcoin at an average price lower than the market's highs, putting you in a strong position to benefit from the growth. This example highlights the power of DCA in navigating both bull and bear markets, allowing you to build a position in a way that minimizes risk and maximizes potential returns. In summary, dollar cost averaging is a powerful strategy for crypto investing. It helps mitigate the risk of volatility, removes emotions from the equation, and allows you to build a position over time. Whether you're new to crypto or a seasoned investor, DCA can provide a disciplined approach that focuses on long-term growth rather than short-term market timing. If you're serious about building a crypto portfolio, DCA is a strategy worth considering. It's simple, effective, and has stood the test of time in various markets, not just crypto. Thanks for watching. If you found this video helpful, don't forget to give it a thumbs up and subscribe to your channel name for more insights on crypto and investing. And as always, leave your thoughts and questions in the comments below. I'd love to hear your experiences with DCA and other investment strategies. Until next time, stay informed and trade wisely.